Welcome back to Accounting 101. In this video, we're going to talk Chapter 8, Accounting for Receivables. Learning objectives for this chapter is to explain how companies recognize accounts receivable. A lot of this section will be a review of things we've seen before, but we're going to be focusing specifically on the accounts receivable portion of the entries in the analysis. 2, we're going to describe how companies value accounts receivable and record their disposition. 3, we're going to explain how companies recognize, value, and dispose of notes receivable. And then finally, describe the statement presentation and analysis of receivables. How do companies recognize accounts receivable? Amounts due from individuals and companies that are expected to be collected in cash is what we're talking about. That's accounts receivable. So here's an example or listing of some big companies and what percentage of their total assets were their accounts receivables. So Ford had a big amount of their total assets and receivables at 25.6%. Tesla, a lot smaller at 3.9%. Amazon, 10.3%. Caterpillar, 22.8%, and Boeing, 12.2%. Now, just as we talked, and we'll continue to talk about when we do this analysis, a single data point doesn't necessarily mean it's bad or good. You can make some initial kind of thoughts about it, but really need to compare similar companies in the similar industries. You might look at this and say, okay, Ford and Tesla, they both make automobiles. Why is Ford so much higher? Then you need to look at Ford has been around for a long time, so a lot of their assets may be depreciated, and we'll talk more about depreciation and fixed assets in Chapter 9, where Tesla, maybe newer factories, haven't been around as long, so they may have higher value of fixed assets. So the total asset is going to change the percentage, the receivable percentage, not just how much receivables you have. So you need to dig into it more than just looking at that, but it's just kind of gives you an idea of how big receivables are to companies. Some different receivables. So we have accounts receivable, and we're going to talk about that in this section. It's the amounts customers owe on account. Notes receivable. This is a written promise for amounts to be received. Normally requires a collection of interest and extends 60 to 90 days. And we'll talk about notes receivable a little bit more in this video. And then other receivables, you can have non-trade receivables such as interest, loans to officers, advances to employees, income taxes refundable, things like that you set up a receivable for to recognize that someone owes you money and what they owe you for. So when do you recognize accounts receivable? Service organization records a receivable when it performs a service on account. Merchandiser records accounts receivable at the point of sale of merchandise on account. And sellers sometimes offer sales discounts to encourage early payment by the buyer. Now, we touched on all of these in previous chapters, especially when we talked about inventory and merchandising companies, service organizations when you perform a service. This matches the revenue recognition, even though you don't talk about accounts receivable as being revenue recognition, but at the time you recognize the revenue, you record the receivable if you're selling on account. The entry to recognize receivable. So assume Patagonia on July 1st sells merchandise on account to Urban Outfitters for $1,000. The terms are 210 net 30. Prepare the journal entry to record this transaction on the books of Patagonia. Now, when we talk about the journal entries for accounts receivable in this chapter, we're going to ignore the cost of goods sold and inventory entries. So remember back when we talked about that in previous, and we had to record the sale and receivable, and then the cost of goods sold and reduction of inventory. We're going to ignore those for simplicity in this chapter. So the entry is simply debit accounts receivable, credit sales revenue. Again, if we did the complete, we would have another entry with debit to cost of goods sold, credit to inventory, but we're going to ignore that in this chapter. Okay, so we've seen this entry before, pretty similar. On July 5th, Urban Outfitters returns merchandise with a sales price of $100 to Patagonia. Again, we've seen this before in the previous chapter. We're going to debit our sales returns and allowances and credit accounts receivable. Urban Outfitters no longer owes us the $1,000, only owe us $900. And instead of reducing our sales, we debit that contra account sales returns and allowances. Then on July 11th, Patagonia receives payment for Urban Outfitters for the balance due. The balance due is $900 because we had a $1,000 sale minus the $100 return. So we're going to credit accounts receivable $900. We're going to receive cash, but the amount of the cash is not going to be the $900. It's going to be less the sales discount. Remember the terms were 210 net 30, so it was 2% if they pay within 10 days, which they did. So we take 2% of the $900, what is remaining to be paid, gets our $18 of the sales discount that we debit that account, and then we receive the rest, the $882 in cash, and we debit cash. Again, we've seen this entry in previous chapter. We're just kind of reviewing it a little bit and thinking about the accounts receivable side. Using retailer credit cards, on June 1st, you use your Target Red Card to purchase clothing with a sales price of $300. Okay. Since it's a retailer credit card, it's Target, they're the ones that are going to be collecting that money. So we're going to set it up as accounts receivable on the Target side. So we debit accounts receivable, credit sales revenue for $300. So we've extended credit. We've sold it on account using that retailer credit card. Okay. Assuming you owe $300 at the end of the month, Target charges 1% per month on the balance due. Target's going to make an adjusting entry to recognize that interest at June 30th, and that's going to be debit accounts receivable, credit interest revenue. Okay, so they're charging that 1%. You now owe Target not the $300 for the stuff you bought, but $300 plus the $3 in interest. Target recognizes that revenue. And then when you pay off your bill, you're going to pay the $303. Okay, so this is a retail credit card, so it's a credit card that's only can be used at that retail location. A lot of companies now are co-branding a national credit card, which is slightly different. So it may have their name on it. You may have a Target Visa card, for example. They would treat that as a national credit card sale, not a retail credit card sale. And we'll see an example of how you account for national credit card sales in a little bit. So here's a fraud example. So we had an accounts receivable clerk for a large nonprofit foundation. Okay, her responsibilities included activities normally assigned to an accounts receivable clerk, such as recording revenues from various sources. However, she was also responsible for handling all cash and checks from the time they were received until the time she deposited them, as well as preparing the bank reconciliation. Remember from chapter 7, this isn't going to end up too well, is it? So she took advantage of her situation by falsifying bank deposits, bank reconciliations, so she could steal cash from the bar receipts. Since no one else logged the donations or matched the donation receipts to pledges prior to receiving them, she was able to offset the cash that was stolen against donations that she received but didn't record. The crime was made easier by the fact that her boss, the company's controller, only did a very superficial review of bank reconciliation, and he didn't notice that some of the numbers had been cut out from other documents and taped onto the bank reconciliation. So she was able to take $1.5 million from this nonprofit. The missing controls, segregation of duties. She should not have been able to, as an accounts receivable clerk, handle the cash, record the cash, make deposits, and then prepare the bank reconciliation. So she had full control over that and with nobody really checking it. And then the independent internal verification. He was supposed to do the thorough review of the bank reconciliation, but since he did not, he was terminated as well. So not only did he lose his job, it was just because he didn't really do what he was supposed to do. He wasn't doing the fraud necessarily. He wasn't benefiting from the fraud, but because he wasn't completing his responsibilities, which would have caught this, they terminated him as well. So let's do this example. On May 1st, Wilton sold merchandise and account to Bates for $50,000, terms 315, net 45. On May 4th, Bates returns merchandise with a sales price of $2,000. On May 14th, Wilton receives payment from Bates for the balance due. Prepare journal entries to record the May transactions on Wilton's books. So we're going to record it on Wilton's books. Wilton's the seller, so we're going to do it from the seller's perspective. We make the sale on May 1st, debit accounts receivable, credit sales revenue for the $50,000. On May 4th, there was a return. We debit sales returns and allowances for $2,000, credit accounts receivable $2,000, so we reduce our accounts receivable by the amount of the return. And then finally on May 14th, when we got the cash received, we're going to receive cash, we're going to debit cash, we're going to credit accounts receivable. The amount that's still outstanding is $48,000, the $50,000 sale minus the $2,000 return. So we're going to credit our accounts receivable at $48,000. Debit the cash received, which is less than that $48,000 because of the discount. The amount of the discount is 3%. So if you remember the terms up here, 315 net 45, 3% discount if paid within 15 days, which they did. So 3% of the amount due, $48,000 is $1,440. Our cash is reduced by that amount. So we debit cash $46,560. Now we'll go on to how companies value accounts receivable and record their disposition. So we've talked before, accounts receivable is an asset. It's a current asset, so it shows up in the current asset section of the balance sheet. Determine the amount is sometimes difficult because some receivables will become uncollectible. We're going to introduce a couple of new accounts here, uncollectible accounts receivable. We record a credit loss as debits to bad debt expense. Okay, it also could be called uncollectible accounts expense, but it's an expense account, shows up on the income statement, and it records our credit losses. These losses are normal and necessary risk of doing business on a credit basis. Okay, so no matter how careful companies are, how much work they go into determining how much to give a customer credit, there's going to be things that happen that you're going to not collect everything in your accounts receivable. That's kind of normal and you expect that. Two methods that we're going to talk about for recording uncollectible accounts. First is the direct write-off method. This is theoretically undesirable. There's no matching between the revenue and the expense. The receivables on your balance sheet are not stated at the cash realizable value, and we'll get into what that really means in a minute. And then it's not acceptable for financial reporting. So if you're producing financial statements, following GAAP, you cannot use the direct write-off method. The allowance method, the losses are estimated. So we're going to estimate what the losses are. It's better matching because we're going to record the expense in the same period that we record the revenue and the initial receivable. The receivables on the balance sheet are going to be stated at a cash realizable value. And if we're following GAAP, we're required to do this. So let's look at a couple examples. So Warden Company writes off M.E. Doran's $200 balance as uncollectible on December 12th. We're going to use the direct write-off method first. That entry is simply debit bad debt expense. So we record the expense because we had to write off the receivable. We're not going to be able to collect it. And we credit or reduce accounts receivable for the $200. And again, this is theoretically undesirable. There's no matching of bad debt expense to sales revenue on the income statement. So we're recording the expense here, but it doesn't tell us from this example when we recorded the revenue. This could be a month old, it could be 3 months old, 6 months old. So we're not matching in the same period necessarily. The receivable, all those interim times, depending on how old the receivable is, were not stated at the amount to be received in cash. So it's not at the cash realizable value, and therefore it's not acceptable for financial reporting. Further on to that, using the direct write-off method, say in year 1, 2027 here, we have a huge sales promotion. Our sales increase dramatically. That means our accounts receivable are going to increase dramatically. It's good. It's all a good thing. Our net income is going to increase as well. The next year, if customers start to default on the loans on what they owe us, our bad debt expense is going to increase, which is going to drive down net income. We also don't have the sales promotion going on, so our revenue is not as high, so our net income is going to fall as well, and our accounts receivable balance is going to dramatically plummet as well. Okay, so that's the reasons why we don't do the direct write-off method, because comparability in when you record the expense and when you record the revenue aren't matched up. So instead we use the allowance method. Okay, this ensures that companies state receivables on the balance sheet at their cash or net realizable value. That is the amount that the company expects to receive in cash. Okay, you make a sale, you expect to receive it all in cash, so you put it on your accounts receivable for the amount of the sale. What we're going to talk about next is we're going to estimate how much of we think that we're not going to be able to collect of those accounts receivables. We already stated that it's a necessary part of doing business on credit is that you're going to not be able to collect everything. So we estimate what that is. When we record that estimate, we're going to debit bad debt expense, just like we do in the direct write-off method. We're going to recognize that expense, increase expenses. So we debit bad debt expense, but we're going to credit this new account allowance for doubtful accounts. So the allowance for doubtful accounts, it's a contra asset account, similar to accumulated depreciation that we talked about a little bit in a previous chapter. So it's going to be contra to accounts receivable. And we know that on contra accounts, it's got a normal balance and it increases opposite of what the account is contra to. So it's contra to accounts receivable, which has a normal debit balance and increases with debits. The allowance for doubtful accounts has a normal credit balance, increases with a credit. So companies debit this allowance for doubtful accounts and credit accounts receivable when they specifically write off a certain account. So we make an estimate based on our total receivables. When an individual account becomes uncollectible and we write it off, instead of debiting the expense like we did in the direct write-off method, we've already recorded that expense with the estimate. Now we're going to use up that estimate that's sitting in our allowance for doubtful accounts. We're going to reduce that and reduce our accounts receivable. So let's look at how this works. Hampson Furniture has credit sales of $1,200,000 in 2027. Of this amount, $200,000 of receivables remains uncollected at December 31st. Credit manager estimates that $12,000 of these sales will be uncollectible. The adjusting entry to record the estimated collectibles increases or debits bad debt expense and increases credits the allowance for doubtful accounts. The entry looks like this. debit bad debt expense, credit allowance for doubtful accounts. Now we said this was the first year of operations up here, so we don't have to worry about if there's any balance in the allowance for doubtful accounts. So whatever we calculated that first year is what we're going to do the entry for. We'll see what happens if, in another example, when we already have a balance in that account. We present it on the balance sheet as a reduction to accounts receivable. So we show our accounts receivable, the gross amount, less our allowance for doubtful accounts. So we get our net accounts receivable or our cash realizable value of $188,000 in this example. So again, cash realizable value is sometimes referred to as accounts receivable net. Now we've set up that allowance. Comes around to March 1st, 2028. We realize we're not going to be able to receive $500 balance owed by RA Ware. So we write off that $500, and we do that with a debit to allowance for doubtful accounts and a credit to accounts receivable for the $500. This is what it looks like using the T accounts when we post that. Accounts receivable had a $200,000 balance at the beginning of the year. We wrote off the $500, so we credited accounts receivable, reduced it down to $199,500. Our allowance for doubtful accounts had a $12,000 balance credit at the beginning of the year. We reduced that by the $500 in this entry, so we debit that account $500, and the balance is now $11,500. So the write-off using the allowance method affects only the balance sheet accounts, so not income statement accounts. So we're doing adjusting it, or we're doing the entry to write off. It's going to affect two asset accounts, the accounts receivable and the allowance for doubtful accounts. It reduces both of those, and the cash realizable value in the balance sheet therefore remains the same. So before the write-off, we had a accounts receivable balance of $200,000. Our allowance for doubtful accounts reduced that by $12,000, so our cash realizable value of $188,000. After the write-off of $500, our accounts receivables was reduced $500. Our allowance was reduced $500. Our cash realizable value stays the same at $188,000. Okay, so we still expect of our accounts receivable balance to collect the same amount. Because we wrote off one of those, we know that's not, we don't think that's collectible, so we wrote it off, but we expect still to receive that $188,000 from our other receivables. Now what happens if the customer ends up paying us? So RA Ware pays the $500 amount that they've been written off. We're going to make some entries to record that. First, we have to write up the accounts receivable. Since we wrote it off, it's not there, so we have to do an entry to debit accounts receivable, credit allowance for doubtful accounts. So we put that accounts receivable back on our books. Then we can apply the cash we received to that accounts receivable, debit cash, credit accounts receivable. Okay, so two entries, two steps. First, we have to recognize the receivable and put that back on our books, and then we can relieve that receivable with the cash that we received. So here's an example. Nike, in their notes of the financial statements, talks about the uncollectible accounts receivable. They say we're making ongoing efforts relating to the ability to collect our accounts and maintain the allowance for estimated losses. Okay, determine the amount we consider historical level of credit losses. So they're looking at historically how much doesn't get paid. They make judgments about the credit worthiness of significant customers based on ongoing credit evaluation. So they could be looking at specific customers and making decisions or estimates based on those individual customers. Since we cannot predict future changes, the financial stability of our customers. Actual future losses may differ from our estimates. Okay, so they're recognizing that it's an estimate and that the actual losses may be different. Percentage of outstanding receivables. It's a common way of estimating the losses. Okay, they estimate the losses as a percentage of what's outstanding. Under this basis, they establish a percentage relationship between the amount of receivables and expected losses from uncollectible accounts. Sometimes when we do this, we look at an accounts receivable aging. So an aging statement simply lists the customers. The total is what the total they owe, so that's going to be our total accounts receivable. And we break it into different buckets, different columns in this case, of how old the receivable is. So if we look at the second one on row 5 here, $300 total is owed and it's not due yet. Okay. If we look at this first one, row 4, we have $600 due. $300 is between 1 and 30 days past due. 0 is between 31 and 60. $200 is between 61 and 90. And $100 is over 90 days old. Okay. Why is it important to do this aging? A couple of things. One, you can, as you see things getting older, you can put more emphasis on trying to collect those from the customers, sending out letters, making phone calls, that type of thing. And then what we're doing here, using the percentage uncollectible, as they get older, there's a bigger chance that you're not going to be able to collect it. So we put a bigger percentage on those older items compared to things that aren't due or just barely past due 1 to 30 days. So we have 2% on things that aren't due, 4% on 1 to 30, 10% on 31 to 60, and then it jumps to 20% and then at 40%. So we're going to use those percentages to what the total balance is in each of those buckets. We do the individual calculations and then add them up to get 2,228 is our required balance in the allowance. So this is looking at the aging. Some of your homework and the exams may ask you to, may give you some of this data and ask you to calculate it. They also may say we have 39,600 and we use X percentage is uncollectible to come up with a number. So could be both ways. Just make sure you understand how to calculate it both ways and what data is needed to do those calculations. So how do we do the adjusting entry? Okay, unadjusted trial balance shows the allowance for doubtful accounts with the credit balance of $528. We did the calculation on the previous slide and says that based on our current accounts receivable, we should have $2,228 in the allowance. We have 528 to begin with, so our adjusting entry is only the 1,700. Okay, similar to what we saw in making adjusting entries in previous chapters. You look at what's in the account, you calculate what the account balance should be, and the adjusting entry is the difference. So we're not recording the full 2,228. We just record the additional amount needed to get to that balance. If we look at the T accounts, we calculated this required balance, so we need to get to that balance. In order to get to that balance, we need $1,700 adjusting entry because we already had $528 there. So now we're going to use the same data. 2,228 is our balance that we need in an allowance for doubtful accounts, but we have a debit balance in that account of $500. The entry we make then is to debit bad debt expense credit allowance for doubtful accounts for 2,728. So it's the 2,228 that we need plus the $500 that's a debit. And here's graphically what it looks like when we post it into T accounts. So we have a debit balance here, 500. We need a credit of 2,228. So we need more than that 2,228 adjusting entry to make it to that balance. Okay. We said earlier allowance for doubtful accounts has a normal credit balance. It increases with the credit. How could we have a debit in that account? Well, remember, when we set up the allowance, we're estimating what that's going to be. We take all write-offs to this allowance account. Even if it doesn't have enough balance to absorb that, we go ahead and record it. We record that with the debit. So if we have a debit balance in that account, it means we've written off more than our previous estimate. So then we have to do an additional adjusting entry, or our adjusting entry is going to be bigger because we wrote off more. Now we're recognizing that expense. Here's another disclosure on accounts receivable, this one from the Container Store. So they talk about accounts receivable being primarily trade receivables, receivables from the credit card processors, tenant improvement allowances from the Container Store landlords in connection with new leases. So an allowance for doubtful accounts is established on trade receivables if necessary for the estimated losses. Factors such as payment terms, historical loss experience, and economic conditions are generally considered. And then the accounts receivable are presented net of allowances for doubtful accounts of 326 and 57 at March 28, 2020 and March 30th, 2019, respectively. So on their financial statements and the balance sheet, they showed just the net amount. So they probably said accounts receivable net and gave a number. They didn't show the gross and then what the allowance was, but they still have to disclose what that allowance is, and they're doing it here in the notes to the financial statements. So there are many pressures on companies to achieve earnings targets. So poor earnings can lead to dismissal or lack of promotion, lower bonuses potentially. So management may be tempted to look for ways to boost their earnings number. One way a company can achieve greater earnings is to lower its estimate of what is needed in its allowance for doubtful accounts. Doing this sometimes is referred to as tapping the cookie jar. So suppose a company has allowance for doubtful accounts of $10 million and decides to reduce this balance to $9 million. As a result, the bad debt expense decreases by $1 million and therefore earnings increase by $1 million. So looking at doing something on the balance sheet, reducing your allowance for doubtful accounts, you can increase your income. So large banks such as JP Morgan Chase, Wells Fargo, Bank of America recently decreased their allowance for doubtful accounts by over $4 billion. These reductions came at a time when these big banks were still suffering from lower mortgage lending and trading activity, both which led to lower earnings. They justified these reductions in the allowance balances by noting that credit quality and economic conditions had improved. This may be so, but it sure is great to have a cookie jar that might be tapped when a boost in earnings is needed. Okay, now this is saying that maybe they were a little bit more aggressive in reducing their allowance for doubtful accounts. That yeah, they may have some instances where a lower balance made sense, but it's just a little questioning and when they do something that big. So how might investors determine that a company is managing its earnings? If the balance sheet reflects an increase in accounts receivable and a decrease in the allowance for doubtful accounts, this could indicate an attempt to manage earnings by reducing the estimated uncollectible percentage. So a good way to kind of look at this also is when you're looking at balance sheets is what is the percentage? What's your allowance versus total receivables? If that's staying fairly consistent or they have good reasoning why that it's going to be different, then you're probably okay. If they aren't disclosing why it's different and it's a lot less, they may be trying to manipulate earnings or manage earnings by using that. Okay, let's look at another example. Brule Corporation has been in business for 5 years. The unadjusted trial balance at the end of the current year shows accounts receivable, $30,000 debit, sales revenue, $180,000 credit, and allowance for doubtful accounts, $2,000 debit. So Brule estimates uncollectibles to be 10% of accounts receivable. Prepare the entry to adjust allowance for doubtful accounts. So first we need to figure out what the balance should be in allowance for doubtful accounts before we can do the adjusting entry. So the allowance for doubtful accounts should be 10% of our accounts receivable balance, $30,000, so 10% of that is $3,000. Okay, so now we're going to debit bad debt expense, credit allowance for doubtful accounts. How much is that going to be? Okay, she said $5,000, that's correct. We had a debit balance there. We need a credit balance of $3,000, so it's $5,000. So you got to remember allowance for doubtful accounts. They told you here that's a debit. If they don't tell you, you assume that it's the normal balance, which would have been a credit, but they told us it's a debit. We need a credit of $3,000, so we need to take into account the balance of $2,000, debit, credit of $3,000, so we need a credit in that account of $5,000 to get to our required balance. Disposing of accounts receivable. So sometimes companies will sell receivables. Two major reasons. The receivables may be the only reasonable source of cash, and billing and collection are often time-consuming and costly. Credit card companies such as MasterCard, Visa, and Discover specialize in billing and collecting accounts receivables. If I'm a manufacturing company that sells to other companies, I don't necessarily specialize in billing and collecting. I do it, it's part of business, but if I can sell my receivables off to somebody that specializes in that, it may be worth doing. So we can sell our receivables to a factor, sometimes called factoring receivables as well. That's a finance company or a bank. That finance company or bank buys the receivables from businesses and then collects the payments directly from the customers. They do charge a fee for this. So they charge a fee to the company that is selling the receivables. We're going to look at some examples where we say the fee ranges from 1 to 3% of the receivables purchased. In reality, it's typically a interest rate, and you look at the time of when you expect the receivables to be collected, and use that the standard interest rate in the market, and then put a fee on top of that. So I've done this a number of times in my career. I actually just had a customer a month ago reach out and wanted to see if we wanted to factor our receivables from them. When we did the math, it just didn't make sense. The fee that they were charging us above the stated interest rate, or the going interest rate, was actually more than what we could borrow from a bank. So our current cash way of getting cash by borrowing from a bank was less expensive than selling the receivables and factoring the receivables, so we decided not to do it at this time. But you need to really look at a case-by-case basis and determine if it's the right thing to do for your company or not. So we'll look at Henderdon Furniture. We're going to factor or sell $600,000 of receivables to federal factors. Federal factors assesses a service charge of 2% in the amount of receivables sold. The journal entry to record this would be debit cash, credit accounts receivable, and then debit service charge expense for the amount of fee they're charging us. So our accounts receivable, the amount we're selling is 600,000, so we're going to credit accounts receivable for that full 600,000. The customers no longer owe us that money. They're going to owe the, in this case, federal factors that money instead of us. The cash we received is reduced by the service fee that we, or service charge that we pay to federal factors. In this case, it's a simple 2%, so 600,000 times 2% is $12,000. In the cash we receive, we debit that, the $588,000. Okay, so that's a recording of selling our receivables. Again, companies do it even though there's a cost, in this case 2%, because we get our cash quicker. So we're going to get our cash today instead of potentially 10, 20, 30, 40, 50 days later, whatever the terms we had with the customer. The bank or the company that is buying the receivables takes on the risk that the customer won't pay that in the future, and they're getting $12,000. They're getting a guarantee that of that $12,000 by doing this, they only have to pay us $588. Then they can potentially, then they will collect the full $600,000 from the customer. National credit card sales. So we had an example earlier of a retail credit card sale. So that's a credit card that can only be used at a certain retail location. We debited accounts receivable, credited sales revenue when we did this. Now we're going to look at national credit card sales. So these are Visa, MasterCard, American Express, Discover. So those are all national credit cards. It's another form of selling or factoring the receivable. In essence, we're getting the cash earlier than if we took credit from our customers, and we are going to pay a fee to the credit card issuer. 2 to 4% typically is what the value or the charge is going to be there. Last few years, you've noticed, you may have noticed if you use a credit card when you eat out, a lot of restaurants are adding that fee or a fee to the amount of the bill if you pay with a credit card. If you paid cash, then you in essence get a discount. So there's they're trying to pass that fee on to the consumer for using that credit card because they have to pay it as part of their business. So advantages of credit cards to the retailer. So the issuer, Visa, MasterCard, or whatever, is the one that investigates the credit of a customer and determines if they're or how much they're willing to risk by offering credit to that individual. The retailer accepts the credit card. The issuer undertakes the collection process. So it's once they get the authorization at the retailer, there's nothing else they do. The risk is all passed to the credit card issuer. The issuer maintains the customer accounts and absorbs any losses, and the retailer receives cash more quickly from the credit card issuer compared to offering credit on their own. So I have an example here. Anita purchases $1,000 of sound equipment for her restaurant from Karen Kerr Music. She used her Visa First Bank card. So it's a national credit card, the Visa. First Bank charges a service fee of 3%. So we're Karen Kerr Music. We're the seller. We're going to record the transaction that Anita bought $1,000 of equipment for us using a Visa card that we accept, and we're going to get charged 3%. The entry is to debit cash, debit our service charge expense, and credit sales revenue. Okay, the amounts are, sales revenue is for the full purchase amount, $1,000. The cash received is going to be that $1,000 less the service charge that we got charged. So 3% of $1,000 is $30. We record the expense of $30 and we receive $970 in cash. So you notice the difference here with using a national credit card, we're debiting cash. We're not setting up that accounts receivable. Because since we got the authorization through the credit card system, we know we're going to get that cash from the bank, the card issuer, so we go ahead and record that in cash. So let's talk about how this works. So what really happens when you use it? So suppose you use a Visa card to purchase some Nike shoes at Foot Locker. You type, swipe, insert your card, allows the information to be read. Salesperson enters the amount of the purchase. The machine then is going to contact a clearinghouse. In this case, they're saying a Visa computer. It goes to the bank that issued your card. The bank verifies that the account exists. The card is not stolen. You have not exceeded your credit limit, and it authorizes that transaction. So this all happens pretty quickly. Sometimes when you're standing there and you're waiting for the machine to process, it doesn't seem like it's very quickly, but in reality, it's pretty quickly to kind of go through all these steps and make sure that it can be authorized. You sign to authorize the transaction. You're saying then I'm going to pay that amount of money to Visa, to my card issuer. Visa says, okay, they're the clearing agent, transfers funds from the issuing bank to the Foot Locker's bank. This usually takes 2 to 3 days, so it's pretty quick. Visa puts a pending charge on your account, so it's going to use up some of your available credit limit. And at the end of the billing period, they send you an invoice, your credit card bill, which shows the various charges and what you have to pay to Visa and at what time to avoid any interest charges, if that's what you want to do. If you go ahead and accept that interest, it tells you how much that interest is going to be. So assume a Foot Locker prepares a bank reconciliation at the end of the month. It's a smart thing to do. If there are some credit card sales that have not been processed by the bank, so we said they're going to get the cash pretty quickly, but it may take 2 to 3 days. So if it hasn't shown up in their bank, but they've recorded the sale as a cash sale, we're going to have a reconciling item. How do we handle that reconciling item? It's going to be a deposit in transit. So we've recorded that we made the sale, that we got the authorization, that we're going to receive the cash. It just hasn't hit their bank yet. So it's just a timing delay. It's a deposit in transit on the bank reconciliation. So let's look at a factoring example. Cal Wholesalers needs to raise $120,000 cash to safely cover next Friday's employee payroll. As an employee, I'm happy about that because they're going to get the cash to pay me. Cal's reached its debt ceiling with its lenders, so they can't go to their bank and borrow more money at this time. They have a outstanding receivables balance of $750,000. They decide they're going to factor $125,000 of its receivable on September 7th to alleviate this cash crunch. Record the entry that Cal would make when it raises the needed cash, and we're assuming they're going to get charged 1% service charge. Okay. We're going to debit cash, we're going to credit accounts receivable, and then again debit that service charge expense. The amount that we credit accounts receivable is the amount that we're selling, $125,000. The cash we received is going to be slightly less than that $125,000. It's going to be less by the service charge, which in this case is 1% of $125,000. So 1% times $125,000, $1,250. So we receive $123,750 in cash. So we debit cash for that amount. Now we'll look at notes receivable. How do we value, recognize, and dispose of notes receivable? So companies may grant credit in exchange for a promissory note. A promissory note is a written promise to pay a specified amount of money on demand or at a definite time. So they may be used when individuals and companies lend or borrow money when the amount of transaction and credit period exceed normal limits, or in settlement of accounts receivables. So 3 examples of when you might do a promissory note. This is what an example of a promissory note might look like. Similar to a check, and it's got a lot of the same information as a check, as this example, but some big differences. So it has the face amount here. It's also got the face amount written out. The due date, so this says 2 months after the date. The date of the note is up here, May 1st, 2027. It says we promise to pay to the order of Wilma Company $1,000 for the value received with the annual interest rate of 12%. So we have an interest rate stated. The maker of the note is Calhoun Company. They're who is borrowing the money. So the maker is Calhoun Company. Debits, cash, and credits notes payable. The payee, Wilma, who's going to receive the money in 2 months. That's the payee. They're going to debit notes receivable, credit cash. So we're going to look at the payee entries in this chapter. Chapter 9, we'll talk about liabilities, and we'll look at this from the maker's perspective. How do you determine the maturity date? So we said the note receivable could be due on demand, which means the payee can demand the note be paid at any time. On a stated date, so it's when you state, this is the date I'm going to pay you, or at the end of a stated period of time. That's most common, and that's what we're going to talk about mostly. So it's going to say, promise to pay you in 2 months. I promise to pay you in 30 days. I promise to pay you in 90 days. So whatever that is. So if we look at that end of a stated period of time, we need to count the number of days. So when we count the days, we omit the date the note is issued, but include the due date. So if we had the term of the note is 60 days, and we issued the note on July 17th, so we ignore the 17th, we count 14 days left in July, so the 18th through the 31st, it's 14 days. August has 31 days, so we add 31 days to those 14 days, and we get 45 days. We're still not to the full term in the note of 60 days. We have to need 15 more days, so we go 15 days into September, and September 15th is the maturity date. Okay, so you have to remember how many days each month has to be able to calculate the due date. Interest, so there's interest on notes receivable. The interest rate that we specify on the note is an annual interest rate. In order to calculate interest for a period of time, we're going to take the face value in the note times that stated annual interest rate times time in terms of a year. That will equal our interest. Okay, what does time in terms of a year mean? So it's either 1 year, a number of months, so you'll take that number divided by 12, or if it's number of days, the number of days of the note divided by 360. Yep, 360, not 365. There's 365 days in a year, but for interest calculation, we're going to use 360 days. The reason for that, the only reason I know of, it just makes the math easier. Okay, I don't know of any specific reason, but it's a lot easier to take 30, 60, 90, 120 over 360 as opposed to over 365 days. So that's the only thing I can think of. I don't know if that's the real reason or the only reason, but that's what I think of it. So here's some examples. We have a note, $730, 12% interest, 120 days. To calculate the interest, we take the face value, 730, times 12% interest rate, times time, 120 over 360. So the interest is $29.20. Next example, $1,000 note, 9% for 6 months. Face value is $1,000 times the interest rate of 9% times time, 6 months out of a year, so it's 6 divided by 12, or 1/2. $45 is the interest. And then finally, if we had a $2,000 6% note for 1 year, face value is $2,000 times 6% annual interest rate times 1, because it's 1 full year, $120. Now we'll look at recognizing notes receivable. Calhoun Company wrote a $1,000 2-month 12% promissory note dated May 1st to settle an open account. Prepare the entry Wilma Company would make for the receipt of the note. Okay, so we'll go back a couple slides. Remember that note that we showed you? Calhoun was the maker. We said Wilma was the payee. We're doing it from the payee perspective in this chapter, so from Wilma's perspective. So the company wrote a note to us. They promised to pay us $1,000 in 2 months. They're going to pay us 12% interest in addition to what that is. They're doing it to settle an open account, which means that we had an accounts receivable from Calhoun for $1,000. They wanted some extra time to pay it, and they just said they would pay interest to us for that, so we agreed to it. So we reduce our accounts receivable with the credit, and we set up notes receivable. We increase notes receivable with the debit. Notes receivable is an asset account. Typically it's current assets because it's usually under a year when they're going to be due, so we put it in current assets. Okay. If the note was just to borrow money, that we were just loaning money to Calhoun Company, they weren't settling an account, we would still debit notes receivable, but the credit would be to cash because we're giving them cash. But in this case, they had an open account. They're trying to settle that open account, so we reduce our accounts receivable with the credit. How do you value notes receivable? Report short-term notes receivable at their cash or net realizable value, similar to what we did with accounts receivable. The estimation of cash realizable value and bad debt expense are done similarly to accounts receivable. And in fact, we're going to use the same allowance for doubtful accounts that we used in accounts receivable. We don't have a separate allowance for doubtful accounts notes receivable. It's just one allowance account. Disposing of notes receivable. So notes may be held to their maturity date, the date that's stated, or the number of days from when it was done. The maker may default, and the payee must make an appropriate adjustment. The holder could speed up conversion to cash by selling the note receivable. So if it hasn't become due yet, we can sell it just like we can sell our accounts receivable. So if the maker pays in full at its maturity date, we say they honored the notes receivable. So it's an honor of notes receivable. If it is not paid in full at maturity, we say they dishonored that notes receivable. We have a notes receivable that was dishonored. It's no longer negotiable. Okay, so we can't sell that to another company because it's already past the due date. Okay, we still could go after the maker and try to collect that cash, and we'll see how we do that. So Wolder Company lends Higley $10,000 on June 1st, accepting a 5-month 9% interest note. If holder presents the note to Higley on November 1st, the maturity date, the entry to record the collection is as follows. We're going to debit cash, credit notes receivable, and credit interest revenue. Okay. Notes receivable gets credited for the face value of the note, $10,000. That's what we had set it up when we accepted the note and lent the cash out. We have interest revenue, so the interest that we are collecting, in this case 9% for 5 months of $10,000, face value times the interest rate times time, So the 10,000 times 9% times 5/12, $375. And the cash collected is the sum of those, the face value and the interest. So $10,375, we debit cash. Now suppose that we prepare financial statements as of September 30th. So it's before the due date. The adjusting entry by Wolder is for 4 months ending September 30th. So like we saw in accruals and deferrals, we have to do an adjusting entry. In this case, our adjusting entry is going to be for 4 months of interest. So June 1st to September 30th is 4 months. It's due November 1st, so it's another month there. So we're going to split up the interest into two periods. $375 cash is what we're going to receive on the due date, but we're going to recognize $300 revenue, so 10,000, 9% times 4/12 on September 30th. So when we do our financial statements, and then we'll recognize the remaining $75 of revenue a month later when we receive the cash on November 1st. So on September 30th, our entry is debit interest receivable $300. So we're going to set up that receivable, and we're going to recognize the $300 of interest revenue. Time has passed. We've earned that revenue, so we're going to recognize it. Okay. Note that we do not use notes receivable. We put it in a separate account, interest receivable, because the notes receivable account stays at the face value. When we receive cash now, on November 1st, we have the same cash received, 10,375, so we're going to debit cash 10,375. We're going to credit notes receivable, $10,000, the face value. The previous example we looked at, we debited or we credited earned interest revenue, $375, but since we already recognized $300 worth of revenue on September 30th, we have that receivable that we're going to relieve, so we're going to credit $300 interest receivable that we set up on September 30th, and then recognize the remaining $75 worth of revenue with a credit to interest revenue. So this is how we got the $75, the $10,000 face value times 9% times 1 month out of 12. That's the $75. If Higley on November 1st indicates that it cannot pay at the present time, they're going to dishonor the note. If we expect that eventually we're going to collect that, so we're Wolder, we expect that eventually we're going to be able to collect it, just not on November 1st. Here's how we're going to record that. We're assuming that we did not make the September 30th accrual of interest. We're going to debit accounts receivable, 10,375, because that's the amount that they owe us now. We're going to credit notes receivable 10,000 and recognize the revenue of $375. We show that they still owe us that $10,375, but it's an account receivable now, not a note receivable, and we're going to work with them to collect that amount. If instead there's no hope of collection, the note holder would write off the face value of the note by debiting allowance for doubtful accounts, crediting notes receivable for $10,000, but we would record no interest revenue because we don't expect to collect that interest. So if they come on November 1st and say, we can't pay you today and we're never going to pay you, they would write off the note receivable by a debit to allowance for doubtful accounts, credit to notes receivable, and not record any revenue. If we had done already recorded that interest revenue with an accrual, we would have to reverse that and take an expense. Oops. Bad information can lead to bad loans. So many factors contributed to the financial crisis of 2008. If you haven't seen the movie The Big Short or read the book, I'd recommend both. It's pretty fantastic. kind of how people were trying to make money when the financial crisis were happening in 2008. So I would highly recommend that. So one significant factor that resulted in many bad loans was a failure by lenders to investigate loan customers sufficiently. So Countrywide Financial Corporation wrote many loans under its Fast and Easy loan program. That program allowed borrowers to provide little or no documentation for their income or their assets. Other lenders had similar programs which earned the nickname liar loans because one study found that 60% of applicants overstated their incomes by more than 50% in order to qualify for a loan. So the banks were just basically giving money away. Critics of the banking industry say that because loan officers were compensated for loan volume, not the quality of the loans, but just how many loans they could write, banks were selling the loans to investors rather than holding them, so they weren't taking the risk on. They were selling that risk to other banks. And if you get into why these banks were paying the money is because the underwriters were saying they were still good loans and they weren't doing their job either. So there's a lot of things that happened to make this financial crisis blow up. But they were selling them so they didn't have the risk, and so they weren't spending a lot of time with the credit worthiness. What steps could they have taken? They should have requested copies of recent tax forms, contacted the supposed employer to verify income, verify ownership and value of assets. It should have examined bank statements, investment statements, title documents, and should have employed appraisers to get appraisals on the property they were loaning money against. So we'll do another example here. Gambit Stores accepts from Leonard Company a $3,400 90-day 6% note dated May 10th and settlement of Leonard's overdue receivable. 3 questions we need to answer. What is the maturity date of the note? What is the interest to be received at the maturity date? And what entry does Gambit make at the maturity date, assuming Leonard pays the note in interest in full at that time? So the maturity date. It's August 8th. How do we get there? It's a 90-day note. We don't count the date the note was written, so May 10th. So we look at 31 days in May minus the 10th. Then when we wrote it, 20 more days remaining. 30 days in June, 31 days in July. That gives us 82 days. So we're not to the 90 yet. The maturity date then is 8 days into August, August 8th. Okay, so remember, you don't count the date that the note was written, and you count the date that it's due, or the date it's due is the last day, the 90th day. Second one, what is the interest to be received? How do you calculate interest? It's the face value times the rate times time in terms of a year equals our interest. So in this case, $33,400 face value, 6% interest rate, 90 days, so 90 over 360 is $51 interest. And finally, what entry does Gambit make at the maturity date, assuming Leonard pays the note in full and interest at that time? We're going to debit cash for the face value plus the interest, so $3,451. Credit notes receivable for the face value, $3,400, and then credit interest revenue for the interest, $51. So that's the entry that we would make on recognizing or on the maturity date when it's paid in full. And now we'll talk about statement presentation and analysis of receivables. We've touched briefly on the balance sheet presentation as we've gone along, but we'll review it a little bit more detail here. So we're going to identify in the balance sheet or in the notes each of the major types of receivables. So either we're going to break it out on the balance sheet or just say receivables and then in a note show a schedule of breaking it out. Short-term receivables as current assets. Remember, current assets are going to be turned into cash within the operating cycle or 1 year, whichever is longer. So it's 1 year, and report both the gross amount of receivables and the allowance for doubtful accounts. So we have to somehow disclose both of those. On the income statement, we report bad debt expense under selling expenses in the operating expense section, and we report interest revenue and our other revenues and gains in the non-operating section. Okay, so bad debt goes into operating expense section, interest revenue goes under other revenues and gains in the non-operating section. Oops. Here's an example of Deere Company in their receivables section of their balance sheet. So they have receivables from unconsolidated subsidiaries. They had trade accounts and notes receivable combined together. They have financing receivables. They had restricting financing receivables and then other receivables. So they add that up to total receivables, and then they subtract the allowance for doubtful trade receivables to get a net receivables of $36,832,000,000. And here's a couple more examples of notes to financial statements from Skechers. So you talk about the minimized likelihood of uncollectability. The credit worthiness is reviewed and adjusted periodically. Looking at financial statements issued by the customer, our experience with the account. When it becomes significantly past due, we generally place a hold on the account and discontinue further shipments to that customer, minimizing further risk of loss. Okay, so that's good disclosure about what they do. And then down here in the second one, our net sales to our 5 largest customers accounted for approximately 9.6, 10.4, 10.5% of total net sales. So their 5 largest customers are roughly 10% of sales in each of those years. But no customer accounted for more than 10% of our net sales during those years, and no customer accounted for more than 10% of trade receivables at the end of 2019 and 2018. Okay, so they're just giving more information about some of their customers and that they've kind of spread out their risk and that type of thing. So analysis of accounts receivable. 2 ratios that we'll talk about. Accounts receivable turnover. That is used to assess the liquidity of receivables. It's computed by dividing net credit sales. So it's net sales less cash sales. Okay, by the average net accounts receivable during the year. It measures the number of times on average a company collects receivables, turning the receivables during the period, not turning the period. The average collection period measures the average amount of time that a receivable is outstanding. This is done by dividing the accounts receivable turnover into 365 days. And it's used to assess the effectiveness of companies' credit and collection policies. So let's look at how we calculate those. So Nike recently had credit sales of $37,430 million, so $37 billion for the year. He had beginning accounts receivable net of $4.272 billion, so $4,272 million, and ending accounts receivable $2,749 million, so $2.7 billion, so they reduced their accounts receivable during the period. Assuming that all their sales were credit sales, so if they don't break it out, you assume that all the sales are credit if it doesn't say specifically. The accounts receivable turnover is that net credit sales divided by average accounts receivable. So in this case, the 37,403 divided by 4,272 plus the 2,749 divided by 2, so a simple average, beginning and ending divided by 2. So 10.7, so the turnover is 10.7, so each year they're turning over their receivables 10.7 times. We can figure out the collection period average by taking 365 divided by that 10.7, and it's on average, we're collecting our receivables every 34.1 days. So from the time we make a credit sale to the time we receive that cash, on average, it's 34 days, just over 34 days. Okay. Again, good information to have. You can make some analysis on this, but it really depends on the industry, and if you're looking at just one company, comparing different periods, does that 10.7 times during this year more or less than last year? And have they said anything about where that's going? So you need to look at kind of a trend as well. Data analytics and receivable management. There are opportunities to improve receivables management through data analytics. Visualization software enables managers to more quickly identify issues and obtain deeper understanding of the factors that influence successful receivables management. Data analytics is particularly valuable for predictive analysis, which allows improved evaluation of customers' risk profiles. Software provided by companies such as Workday use artificial intelligence to forecast which customers are likely to pay late. So we're taking a lot of data and crunching it, coming up with some insight. Offering credit to customers has cost, as some credit customers will ultimately not be able to pay the amounts owed. Companies can minimize these costs by effectively analyzing data regarding current and potential customers. Traditionally, they base credit decisions on a limited number of factors: customer's payment history, credit history, debt to assets ratio. In contrast, credit granting decisions using big data can take into account hundreds or even thousands of data points. These can even include customer social media network, spending habits, criminal history, cell phone information. As the CEO of one online lender stated, all data is credit data. Data analytics can be used for estimating uncollectible accounts and minimize bad debts. For example, companies can use data analytics to determine the normal payment patterns of specific customers and then automatically generate phone calls whenever these customers deviate from their normal patterns. Resolving accounts receivable issues earlier increases the likelihood of the receivables of it being resolved favorably. Why might a company want to consider a customer social media network when deciding whether to grant the customer credit? Customer's social media network might indicate if the applicant's contacts have had some negative experiences with the applicant, such as the applicant having a history of paying very slowly or not at all. So again, just another data point, and you're trying to make better decisions with those data points. Here's an example of a potential example of a accounts receivable dashboard. We've got the aging over here, so that's being probably updated daily or real time. So you can see, you know, over 120 days is big. It's bigger than your on time, so you may want to go after that. Who your top customers are as far as how much they owe you and what their payment looks like. It's got the total outstanding amount, number of invoices outstanding. So a lot of information here that companies decided is important and can help the managers make decisions, and looking at this all in one place and doing it quickly. So 2027, LeBron James Company has net credit sales of $920,795 for the year. Beginning accounts receivable net of $38,275, ending accounts receivable net of $35,988. So we need to compute LeBron James Company's accounts receivable turnover and average collection period in days. So again, accounts receivable turnover is the net credit sales divided by average accounts receivables. That gives us our turnover, and then we take 365 divided by that turnover to get the collection in days. And if we do that with this data, we take the 923,795 divided by the average net accounts receivable. So 24.9 times is the accounts receivable turnover. And if we turn that into days, 365 divided by 24.9, it's 14.7 days. So on average, we're getting paid in less than 15 days when we make a credit sale. That's it for Chapter 8. Please reach out if you have any questions. There'll be your homework due in this chapter, so work through that homework. And there's also some other examples that I will post on Blackboard as well. Thank you.